Welcome back. Prices of many commodities, from metals to grains, have come off their 2022 highs. Metals have been hounded by doubts over China's pace of growth, while agri-commodities like sugar and wheat and edible oils, while off the post-Ukraine war highs, are still close to all-time highs, in part due to El Nino fears. The resultant inflation fears are for all to see. I mean, more and more rate hikes expected from the Fed. You can see it in the US bond yield rates. Today, I have with me Juerg Kiener, Managing Director and CIO at Swiss Asia Capital, by far one of the keenest watchers of the commodity space. Good morning, Juerg, and thank you very much indeed for joining us. I don't know where to start. There are so many commodities that India desperately needs and which are in a state of flux. Let me start first with gold. Your brave prediction of 4,000, does it still hold? We've not seen gold do too much in the first 8 weeks of the year.
I think if you look at most commodities, and that includes the precious metal space, it had a very good January. And I think you've seen that most of these commodities given most of the gains away in February, which basically tells you have a lot of volatility. But the swings are actually quite enormous. And the swings are happening because of what everybody talks about, the Fed and interest rates, and they're worried about it. But they keep forgetting that actually in the 70s, we had periods where interest rates went up to 18%, and we had a commodity boom. And I think we are in a very similar environment today where you have huge shortages, misallocation of capital, misallocation of inventories at 40-year lows. And it doesn't need very much to get an injection into these prices and catching up actually with everything else which is happening in the market.
Okay. No, so to come back to gold, do you think that it's going to rise like the way it did in the 70s? There were predictions of $4,000 late last year. So is it still likely to see a lot of attraction in the current year?
If you look right now, we are in accumulation mode. Governments are accumulating at record speed precious metal because they want to reduce the counterparty risk. And that we'll see to continue. And inflationary pressures brings private people to the segment who want to have protection of their savings. So that's the second one. So the derivative book right now, which is playing on COMEX mainly, is dictating the price. But it's under pressure because of low inventories. So once that comes under pressure, your market will liberalize the price. And then the question is, how far will it go to find stability? And these moves can be quite energetic. And you've seen that in nickel market last year when it boomed and they had to close the exchange because they couldn't deliver anymore. And people like Trafigura almost went belly up. So I think you're going to actually see very similar things in that space as the market gets tight and the availability to deliver is not going to be here anymore.
Okay. All right. Then with that, let me come to metals. We are, getting into a Chinese meeting as well over the weekend. The metal market also has given up gains in part because the Chinese recovery is seen a bit uneven and erratic. The spate of rate hikes are expected to reduce demand in the second half of the year. So are you bullish on metals? And if yes, which one?
I think the whole commodity space looks really good. Oil, the metals, everything looks really good. I mean, I said most metals are on a 40-year low on inventories on the LME. That just doesn't work. You're going to need an incredible recession to make that work. And I can't see that happen at the time when the governments are trying to support economic growth, despite interest rates moving up. So the cost has gone up, but in return, actually, we still stimulate to keep the social stability happening. And the other two reasons why I'm really very positive is you are restructuring the global economy by localizing instead of globalizing. And that's a capital investment cycle. And the second point is actually everybody starts building up military capabilities. And that's incredibly commodity intensive. It needs a hell of a lot of metals and steel. And so that's the support actually, which is taking the demand up and not necessarily the building of houses right now. So it's the rebuilding of the world's infrastructure and how we want to live down the road, which is creating the demand cycle. And that's totally underestimated in today's world.
Okay, now that's four solid reasons all-time low or 40-year low in terms of inventories. The world is in a mood to build its infrastructure. Geopolitics is going to consume more military hardware, and there is nearshoring, onshoring, which is going to mean lower productivity or higher cost. So yes, the case for metals seems well made. Is there a pecking order? I mean, would you prefer copper over aluminum? Would you prefer steel over either of these?
Look, I like things which are not too energy intensive, and that means aluminium is difficult to play. You really have to see more locally what the differentiation on pricing is. We really are very positive on copper. We are very positive on silver, on zinc, on lead. And we are very bullish, actually, the green metals, which are being used in our new world of energy infrastructure. And I think that's a very tiny market. It doesn't need very much money to actually change prices.
When you say green metals, you mean things like lithium?
Oh, lithium is a certain one area which you see very big price swings. They're very even bigger than actually in the precious metal or the energy universe when you look at the ups and downs. But you start seeing that the offtake arrangements and the availability to secure the delivery is at the forefront right now. That means prices will stay higher for longer.
Mm-hmm. Okay, then let me come to the one that perhaps India fears the most, crude. We have, fortunately for us, seen it recede from the post-Ukraine highs of $130. But it's not quite going below 80. What's the near-term range for crude and the range for 2023 itself?
Look, I think the bottom of crude is more or less in. Maybe have another $5 or $10 on the downside, versus what's the upside is actually quite significantly. And India right now doesn't even pay market price. So it's actually very positive for India, for your GNP. And positive for your GNP means your demand on actually all these goods we've been talking about is going up. So instead of always looking at China, you should actually look a bit at your own country and feeling confident that actually price will go up.
Okay. No, that's true. We are in a bit of a sweet growth spot, though, of course, we crib about the consumption being plateauing. In any case, so you expect that there isn't much of a downside, probably another $5, but the upside looks pretty unlimited for the current year for crude.
Look, I think all commodities have a very, very good picture in an environment where actually the BRIC countries are looking to bring commodities as backing for currencies back into the system. And that means you have a deleveraging on the Western side of derivatives, whilst you're actually bringing the stuff back in the BRICS. This stability means you're going to get more volatility as we shift from one world to another world. But overall, that means higher prices. And the only thing which will be bringing prices down would be a financial crash, something like in 2020, 2019, where things basically dislocated and everybody was thinking it was the end of the world. Then you might get lower prices. But otherwise, you're going to get significantly higher prices looking in the next 12 to 24 months.
Well, one hopes at least that level of instability is not on the cards just yet. At least the central bankers are not talking about it. What about softs? In India itself, there are these El Nino fears. But do you think sugar has more legs to run, wheat has more legs to run, even cotton?
To be honest, I'm not really a specialist of agri, so I wouldn't really want to say too much. But if you look at the world, we've got massive changes in climate, from warms, from wet, from too much water, not enough water. Inventories in general are low too. So I think they should find quite decent supports. What agris don't like is weather patterns which are not predictable, because it reduces yield in general.
Okay. So overall, would you say that this year commodities can give you better returns than equities?
Look, if you look at commodities itself, they're priced in a derivative market, which is basically a yield-bearing structure. So as interest rates go up, I don't know where prices really will be. But if you look at the commodity producers, you see a lot of producers which are trading, at single-digit PEs with double-digit yields. To me, that's a very attractive environment to pick actually the stock up, because you're getting paid handsomely at the time when interest rates are relatively high. and you are cash flowing. You have huge free cash flow for a lot of the names. And so a shift from financial assets, which have poor yield, poor visibility, a lot of pressures basically in the realignment of the economy, they're probably going to struggle to improve in value. And from that point of view, an asset allocation shift into something which has a higher protection and is need-based is probably making much more sense than something which has to be priced on a 10-year forward curve, particularly in the technology side, where you don't really have that much certainty. That's going to be probably pretty much of a struggle.
Okay, well, finally, let me end where we began. We began with gold, but I didn't dwell enough on silver. At about $21 today, do you think it has a tendency to go towards those, 25, 30 levels that we saw at the end of the last decade, around the 2010 levels?
So let's look at the price segment from a silver producer. If you're basically a silver producer, your cost base without making any money is probably for most people around 19. So you're trading today 21, so your risk is actually close to zero, right? We all need to make a bit of money to survive. Yes. So you have upside potential. And when you have upside potential in a tiny market like that, which has been washed out by derivatives, you have actually a very good chance that you actually get the knee-jerk reaction. Momentums look actually like that, so you could actually get a decent short squeeze. So moving well above $25, $26 should be a probability which has very good a possibility structure, really. So we're looking for something which could spike actually quite significantly.
Oh, that's important. Can you leave me with a number for gold for the current year?
Look, is it going to be by 31st of December or sometimes next year? I don't know. I think we're going to make new highs. And as we make these new highs, the market can actually start finding its own way to higher levels. And the main reason I'm looking at that, it's like silver, a market which has been backwardation for a long, long time. And so COMEX and the LME and the LBMA are struggling to find supply. You've seen the BIS coming back to the market to actually arrange for a new gold physical loan, having departed at the end of last year. And that brought the price down a little bit. We expect the BIS to actually start pulling that loan back, going back to zero, because they see the same shortages we see. They don't want to have too much outstanding physical in the market, and that will move the price significantly up.
Okay, we'll leave it at that. Thank you very much indeed, Juerg Kiener, for joining us with your analysis of all the important commodities for India. Be prepared for fresh all-time highs on gold, is what he's saying. I think 2,100 or what we saw about a year back, that could be crossed. As well, silver, $26. We are now at 2021. That's an important one. And metals, also expecting that to be high because LME inventories are at 40-year lows, and the world is building its infrastructure at a time when there's a lot of distrust and people want to build most of the metals in their own shores, which means higher cost. So, okay, looks like bullish times for commodities. We'll wrap up on that note and get back to equities and trading ideas on Chartbusters.
Co-powered by